Hi, I'm Sachikira. Today we will solve exercise 21-18, multinational transfer pricing, effect of alternative transfer pricing methods, and global income tax minimization. Please pause the video to read the question and then continue with the video to follow along with the solution. First question requires us to calculate the after-tax operating income per unit earned by each division using three transfer pricing methods given in this question. To attempt the first question, we will follow the three steps. In the first step, we will convert the summary data in Canadian dollars based on the exchange rate that is provided in the question. In the second step, we will calculate the transfer prices under each of the three methods. And the last step, we will calculate the after-tax operating income per unit. So let's get started for converting the summary data into Canadian dollars. We know that the China division basically had a variable cost of 1,000 yuan. When you take this 1,000 yuan and divide that by 8 yuan, remember that's the information, the exchange rate that was given to us in the question, you arrive at 125 Canadian dollars per subunit. Now you're going to use the same thing for the fixed cost. The Chinese division incurred 1,800 yuan for the fixed cost. Divide that number by 8 yuan to convert it into the Canadian dollars, which is equal to 225 Canadian dollars per subunit. Now for the South Korean division, our variable costs were 360,000 won. Divided by 1,200 won per dollar, which gives us 300 per unit. Fixed cost 480,000 won divided by 1,200 won per dollar gives us 400 per unit. And for Canadian dollars, there's no conversion required as variable costs were already given to us in $100 per unit and fixed cost of $200 per unit. Now let's convert the market prices into Canadian dollars as well. We know from the question that both Chinese as well as South Korean divisions, they sell parts of their production to private or other companies. So for Chinese division, we know that the part is sold for 3,600 yuan. Divide that by, again, the exchange rate of 8 yuan to give us the Canadian equivalent of $450 per subunit. Now, South Korean division also sells the parts to a third party for 1.56 million won. Divide that by the exchange rate of 1,200 won, which gives us $1,300 per unit. For the market price transfer pricing method, basically remember in the section above, we calculated that China division actually sells the subunits for $450 to other Chinese companies. That's the information we are going to use and assume that China, when it sells the subunit to South Korea, it sells each unit at $450 per subunit. Similarly, for the South Korean division, it sells unit for $1,300 to other South Korean distributors. That's the information we are going to assume when South Korea also sells units to our Canadian division. So our market price is going to be $1,300 per unit. Our second transfer pricing method is based on 200% of markup on the full cost. So for our Chinese division, we know that the variable costs are $125 and the fixed costs are $225 per unit. So when China sells the parts over to South Korea, we are going to assume 2 times the total cost of 125 plus 225, which is equal to $700 per subunit. Now for the South Korean division, transferring units over to Canada, again, we have to mark up the total cost by 200%. So hence 2 times the total cost. Now remember, South Korea's total cost includes the prices it paid to China, so $700, plus a variable cost of $300 and fixed costs of $400. So in total, basically South Korea will receive $2,800 per unit when it sells the units over to Canada. Moving on to the last transfer pricing method, it comprises of 300% of markup of variable costs. So again, when the China division sells to South Korea, we are going to mark up the cost by 300%, hence 3 times. This time we are only going to use the variable cost of 125. So 3 times 125 gives us $375 per subunit. When South Korea actually moves their units over to Canada, they will get 3 times 375, which is what it costs them to get the units from China, plus another variable cost of $300. So 3 times the total of 375 plus 300 gives us $2,025 per unit. The third and final step is to calculate the after-tax operating income per unit earned by each division. So let's get started. I would like each one of you to first create 4 columns. First for the description, second for China, third for South Korea, and the last one for Canada. Method A, internal transfers at market prices. Based on the previous slide, we know that China sells the units at $450 market price to South Korean division. So that's the revenue for the Chinese division. There are no transferred in costs as China is the one that manufactures the units. Then for the variable cost, we know that China incurs $125 and then $225 for the fixed cost. So the total division costs are $350. And the operating income is $100, which is $450 minus $350. We know that China has an income tax of 20%, so take another $20 off, and hence the net income per unit for China under market price is $80 per unit. Moving on to South Korea. South Korea earns a revenue of $1,300 per unit when it transfers each unit over to Canada. It incurs $450 of transfer in cost from China, getting the manufacturing units from China. Then in addition to that, it has variable cost of $300 and fixed cost of $400. So when you add these 3 numbers up, you arrive at a total cost of $1,150 and an operating income of $150, which is $1,300 minus 1,150, resulting in 1,550. With an income tax of 20%, so 20% of 150, which is $30. Hence, your net income per unit for South Korea is $120 per unit. For the Canadian division, the final selling price is $3,200 per unit, that's the revenue, minus the transfer in cost from South Korea, which is $1,300 plus another variable cost of $100 and fixed cost of $200. So when you add $1,300 plus $100 plus $200 comes to $1,600 of total division cost. When you subtract the $1,600 from the $3,200 of revenue, you arrive at the operating income of $1,600. Now for Canada, the tax rate you recall from the question is 30%. Hence, you take off $480 for the income tax, resulting in a net income of $1,120 per unit. For method B, internal transfers at 200% of full cost, if you recall from the previous slide, we know that for China, the revenues are $700 per unit and zero transfer in cost, variable cost of $125 and $225 for the fixed cost, hence the total division cost is $350. So the division operating income is 700 minus the 350 total cost, resulting in the operating income of $350. And with the tax rate of 20%, we have to take off $70 from that number to arrive at $280 of net income per unit. Continuing along, for South Korea, we know that the transfer price, so the revenue is 2,800, again from the previous slide. Now we know that the cost, the transferring cost is 700. Remember, that's what China received from South Korea. So $700 plus the variable cost of 300 and the fixed cost of 400, coming to a total, so 700 plus 300 plus 400, a total of $1,400 for the division cost. Subtract that number from the revenues of 2,800, we arrive at an operating income of $1,400. Now deduct the income tax of 20%. So 20% of 1,400 results in $280. And if you subtract that from our operating income of $1,400, we arrive at a net income per unit of $1,120. For Canada, we have the revenue of 3,200, transfer in cost of 2,800, plus variable of 100 plus another 200 for fixed cost, so a total cost of $3,100 for an operating income of $100 minus the tax rate of 30% gives us the division's net income of $70. Now for the last method of internal transfers at 300% of variable cost. For China, we know that the transfer price is $375 per unit. And when you subtract the division cost of $350 from that number, operating income is $25 and after-tax net income is only $20. For the South Korean division, we know that the transfer cost is at $2,025. And when we reduce all of the division costs from that number, so the division cost, total division cost is $1,075, we get an operating income of $950 and then an after-tax net income of $760. And then when we look at Canada, basically our transfer price is $3,200 and we subtract all of the costs, so transfer in cost, variable cost, and fixed cost, we arrive at an operating income of $875 and after-tax net income of $612.50. Second question is trying to figure out which transfer pricing method will maximize the after-tax income per unit for user-friendly computers. For that, basically, we will take the net income for each of the divisions and add them up for the three transfer pricing method that we calculated on the previous slide. So for market price, when you add up the net income for all three divisions, you arrive at a total net income of $1,320 for the company. For 200% of full cost, you arrive at a total net income of $1,470 for user-friendly. And for the last transfer pricing method of 300% of variable cost, you arrive at $1,392.50 for user-friendly computers. So in essence, when you compare the three methods side by side, you can see the method in the middle, which is 200% of full cost. This is the method where user-friendly maximizes its total net income. And the reason for this one is that the largest portion of the income remains in Korea, and this is the country with the lowest income tax rate in our example.